Welcome back to another episode. In today's program, we're going to be talking about retirement plans for the business owner, more specifically for the solopreneur. So if you're a business owner or a solopreneur, we're going to talk about the SEP IRA and Solo 401k, which more specifically can allow you to contribute substantially larger dollar amounts in comparison to just an IRA. Now, before we get started, as always, make sure you hit the subscribe button as well as the little bell icon. That way we can send you all of our alerts when we have a new released video. Let's get started. As we always do in this episode, we'll answer one of our viewers' questions at the very end, so I encourage you to drop your questions and or comments in the comments box. The SEP IRA and Solo 401k for the business owner and solopreneur. As we said, the major benefit for a lot of investors is that they can contribute substantially larger dollar amounts compared to an IRA. So in 2023, you can contribute up to $6,500 to a traditional or Roth IRA when you're under the age of 50. When you're 50 and over, you can contribute up to $7,500. There's a $1,000 catch-up. Now, in addition to an IRA, if you qualify, you can also look to establish a SEP IRA or a Solo 401k for yourself as a business owner or solopreneur. So let's break down the contribution limits first. Let's start with the SEP IRA. The SEP IRA stands for Simplified Employee Pension IRA. Think of it like a pension that you would have for your own business or a pension you have for a company you work for. The company puts money into the pension, and then there's a benefit payout later on in your retirement. A SEP IRA works very similarly in that the employer makes a contribution to your SEP IRA. Now keep in mind, as a solopreneur, you're wearing both hats. You're an employee and you're an employer. So the SEP IRA, an employer contribution is made, and that employer contribution is tax deductible. So think of the SEP IRA just like a traditional IRA. Money goes in, you get a tax deduction, it grows tax deferred, and then when you take the money out during your retirement years, that's when you pay taxes. Like we always say, you either pay taxes on the seed or you pay taxes on the crop. With a SEP IRA, you're not paying taxes on the seed, you'll grow the account tax deferred, and then you'll eventually pay taxes on the crop. So how much can you contribute for 2023 to the SEP IRA? You can contribute up to $66,000, not to exceed 20% of your self-employment compensation, or if you're set up as a W-2 type structure, it would be 25% of your annual compensation. Now, what is annual compensation as it relates to contributing to a SEP IRA, Solo 401k, or other employer-based plan? Well, when you hear annual compensation, you really want to think earned income. See, earned income is the income that is used to contribute to one of these retirement plans. So what is earned income? Well, earned income is income that you're paying taxes on, and in addition to income taxes, you're also paying payroll taxes. That would be Medicare and Social Security. So in other words, if all of your income is passive income and you're not paying Medicare and Social Security tax on that income, that's not earned income, and therefore you can't use passive income to contribute to an employer-based plan like a SEP IRA or Solo 401k. Hey, how's it going? I'm right in the middle of recording another Getting Real video.
60-second challenge, John.
Okay, let's go for it. All right, I'm back. My team here likes to interrupt me and do what they call the 60-second challenge, and that's on TikTok if you want to check it out. So they grab me unannounced, and I have to answer a question in 60 seconds. And as many of you know, it's a little bit difficult for me to answer questions in under 60 seconds. So let's get back into it. Contribution limits. So we want to talk through how much can you contribute to a SEP IRA or Solo 401k in one individual given year. So let's go ahead and jump into some examples. Let's say that you have $300,000 in compensation and you're set up self-employment. 20% of $300,000 is $60,000. So you can contribute $60,000 into the SEP IRA, and you would receive a $60,000 tax deduction. And then that account is going to grow tax deferred. Now let's use another example. Let's say you're paying yourself $100,000. That is compensation, earned income. 20% times 100,000 is $20,000. So 20,000 goes into the SEP IRA. You go from $100,000 in taxable income down to $80,000, hence the tax deduction. Now you have $20,000 in the SEP IRA. One question I get oftentimes is, can I backdoor that SEP IRA money into a Roth IRA? And the answer is absolutely. So every year you could contribute to the SEP IRA. In my example, I said 20% of 100,000, 20,000. The 20,000 goes into the SEP IRA. You then convert that money over into the Roth, and now you have 20,000 in after-tax dollars in your Roth IRA. So the 20,000 goes into the SEP. You recognize a temporary tax deduction. The money then shifts over into the Roth via Roth conversion, and now you have money in there after tax. Some people like to refer to that as the SEP backdoor Roth conversion, just like if you contribute to a traditional and then immediately convert over to a Roth. Now, oftentimes, business owners or solopreneurs don't have any employees. So they open up the SEP and they make a contribution and they only have to worry about themselves. But what if you have W-2 employees? Not 1099 contractors, because those are not employees, but what if you have actual W-2 employees? Now that could be family members or it could be non-family members. Keep in mind that any W-2 employees, if they are eligible and you are contributing to your own SEP IRA, you also have to contribute to all eligible employees. So for example, let's say you were paying yourself $100,000 and you had an employee that you were paying $100,000 in salary every year. And so let's use 25% if you're set up as W-2. 25% would be the maximum you can contribute to your SEP IRA. And let's say you decided to do the maximum of 25%. So 25% of 100,000 is 25,000. 25,000 goes into your SEP IRA. Now you have this employee, let's assume they're eligible, and you're paying them 100,000. So you would also have to take 25% of their salary, which is 25,000, and put that 25,000 into their SEP IRA. So they would open up a SEP IRA. It could be self-directed if they wanted it to be with a company like Equity Trust, so they could invest in real estate and other alternatives. And that 25,000 would be in their SEP IRA. That comes from the business. So the business recognizes the tax deduction for the contribution to the employee's SEP IRA. It doesn't come from the employee's salary or their wages. It's coming from the business. Now, let's talk about that eligibility for a moment. There are employees that you are allowed to exclude from the SEP IRA. When you establish a SEP IRA, you're going to fill out what's called a 5305 SEP Form. And there are boxes that you can check to establish these parameters. So if you have any employees that have not worked for you 3 out of the last 5 years, you can actually exclude them from the SEP IRA. So let's say you've had your business up and running for several years now, so you certainly have worked there for more than 3 out of the last 5, and you hire on a new employee, brand new. You wouldn't have to contribute to their SEP IRA until they meet the minimum eligibility requirements, which you can set at 3 out of the last 5 years. Now, if you have a brand new business and it's just you would set those numbers lower so you can contribute to your own plan. And if you wanted to contribute to an employee's account and you wanted to set that number lower than 3, you could absolutely do that. You can also exclude any employees who are under the age of 21. But once they get to 21 or older, you have to permit the contribution to the SEP IRA. You have to make that contribution, as well as you have that 3 to 5 that we just talked about. And then there's also an annual compensation, which varies from year to year. Currently, it's about $700. So if you have an employee that makes under $700, you can exclude them from the SEP IRA and you having to make a contribution to their account. Now, as I said before, with a CPA or tax professional, I always encourage folks before they proceed with opening up a SEP IRA for their business to have a conversation with their CPA or tax professional to make sure they're not running afoul of any of the IRS guidelines or Internal Revenue Code rules. Lastly, on the SEP IRA, I mentioned the backdoor conversion to the Roth IRA. Keep in mind that you can contribute to both your SEP IRA every year and you can contribute to your IRA on an annual basis. All right, so now let's shift from the SEP IRA over to the solo 401k. And as we make this transition, again, it's important to keep in mind that you have to select from one of the two. You wouldn't be able to contribute to both or establish in the same year both a SEP IRA and a solo 401k. SEP IRAs are very easy to establish, very easy to fund, generally very low cost. The solo 401k, as we transition here, you're going to learn it's a plan, and then you become a participant of that plan, and you could also potentially have a spouse as a participant. Just like a SEP IRA, if you have family members that work in the business, you might want to consider helping them save for their retirement early on and making contributions to their account as you're making contributions to your account. So the solo 401k, let's break down the contribution limits to a solo 401k first. With a solo 401k in 2023, there is an employee and an employer contribution. As an employee, when you are under the age of 50, you can contribute up to $22,500. When you're 50 and over, you can contribute up to $30,000. There's a $7,500 catch-up contribution is what they refer to that as. Just like the IRA catch-up of $1,000 once you turn 50 or older, the 401k has the same aspect, which is once you get to 50 and over, you can make an extra $7,500 contribution, taking you from $22,500 again up to $30,000. Now here's what's really interesting about the solo 401k in contrast to the SEP IRA. The employee contribution, that can be up to 100% of your compensation. Just like the SEP IRA, you have to have taxable income, income that you're paying Medicare, Social Security tax on, so self-employment tax, and your income taxes. So it works the same as the SEP IRA in that respect. But it can be up to 100% of your earned income. So let's use the example, let's say Jim Smith is making, I'll just use an arbitrary figure of $33,250.22. And Jim wants to make the full $30,000 employee contribution to his solo 401k. Jim would have the ability to do that because it can be up to 100% of your earned income. So that's the employee contribution. Remember, as a solopreneur business owner, you wear both hats, an employee hat and an employer hat. So our employee contribution, $22,500 or $30,000, and then we put on our employer cap. Now the employer can do a profit sharing match, also referred to as an employer deferral. Now that amount, if we combine the employer match or profit sharing contribution plus the employee contribution, the total amount that you can contribute to your solo 401k in one given year in 2023 here would be $66,000 when you're under the age of 50. If we account for that catch-up contribution when you're 50 and over, you can get up to $73,500 into the 401k. As we're calling it here, the solo 401k for the solopreneur. So that's pretty exciting. You can contribute a substantially larger amount to a solo 401k in one given year compared to an IRA, and potentially more than you can contribute to a SEP IRA. So that is one advantage of the solo 401k versus the SEP IRA, is you can get up to 100% of your earned income as your employee contribution. Now the employer profit sharing or employer deferral, important to understand that you're going to be limited to 20% of your self-employment income there, or if you're set up as a W-2 structure, 25%. So you have to be paying yourself enough in order to get that full $66,000 into the plan when you're under the age of 50. Again, $73,500 when you're 50 and over. So let's do a quick example. Let's say that we have an individual that is 50 or over, and they're making $100,000. They have $100,000 in compensation. So let's assume that they want to do a full employee contribution of $30,000, which they're permitted to do. So they put their $30,000 into the solo 401k. And then let's assume they're set up self-employment, so we're going to use 20%. 20% of $100,000 is $20,000. So you got your $30,000 employee contribution, your $20,000 employer deferral. The combined amount is $50,000 in that solo 401k. Now here's where things get very, very interesting with respect to tax deferred versus tax free. You remember how I talked about the SEP IRA? When you make a contribution, the business gets a tax deduction for it. And then if you wanted to, you can convert it over to a Roth. Well, the solo 401k allows you to sort of shortcut that employee contribution and go directly into a Roth component. So the $30,000, in my example, contribution, instead of going into a tax deferred bucket and you getting a deduction, you can put it directly into the Roth money source after tax. So you don't get a deduction on it, but now you have $30,000 in a Roth component, they refer to that as, into a Roth bucket. So the growth of that Roth, providing you follow the rules, will be tax-free. And then when you take the money out, just like a Roth IRA, after the age of 59.5, you pay 0% tax. So you could create substantially larger amounts of these tax-free dollars. What's also interesting about the solo 401k with this Roth component is if you make too much money. So one of our previous episodes, we talked about the modified adjusted gross income limits. If you make too much money, you can't contribute directly to a Roth IRA. But with a solo 401k, you don't have to worry about those modified adjusted gross income limits. You can contribute directly to that Roth account. Now going back to our example, $100,000 in income, $30,000 can go directly into that Roth. The $20,000 employer match, if you will, employer deferral profit sharing, that money must go into the tax deferred bucket first because the business will recognize a tax deduction. Just like when you go work for a company and you get a 401k, they match you, that company gets a tax deduction for that, right? And so what you can do with that $20,000 that I'm referencing here that goes into that tax deferred bucket is you can immediately do what's called an in-plan conversion. Folks, this is really exciting because the $20,000 can go into the tax deferred bucket, you recognize a temporary deduction, and then you immediately convert it over to the Roth bucket. Again, this is known as an in-plan conversion, and it hasn't existed forever. It's actually fairly new. And so you convert that over into the Roth bucket. Using our example of an investor making $100,000, $30,000 going into the Roth bucket directly, $20,000 going into that tax deferred bucket, and then in-plan conversion over to the Roth, you now have $50,000 in the Roth bucket of that solo 401k. Now, let's pivot to eligibility requirements for just a moment. So I mentioned solopreneur, business owner. With a solo 401k, unlike a SEP IRA, with a solo 401k, you cannot have any W-2 employees with the exception of a spouse. Now that's interesting. You can employ your spouse, providing they're providing services and such to the business. You can employ your spouse and they can be a participant of the 401k plan as well. Now that's interesting because if they're making enough, let's say you're paying yourself $100,000, they're making $100,000 a year, you're both 50 and over, using that same example, you got $50,000 into your Roth and $50,000 into their Roth bucket of the 401k. So you could substantially contribute larger amounts if you're set up in that fashion. If you have any employees, you will not be eligible to open the solo 401k. You also have to keep in mind that if you have multiple businesses, those businesses could be considered to be in a control group, and if you have employees for those other businesses, that might disqualify you from having a solo 401k. This is where you really want to make sure you're consulting with your CPA or tax professional to make sure that you're following all of the rules and guidelines. There is one other exception. If you have other partners in the business, and those partners have at least a 10% ownership interest or greater, then in theory you could potentially still have a solo 401k and all of those partners could benefit from the use of the solo 401k. That being said, generally speaking, solo 401ks, think solopreneur, think business owner who doesn't have any employees with the exception of maybe a spouse. So hopefully you got some information in terms of the pros and cons between the SEP and solo 401k and can now come to a conclusion as to, do one of these plans actually make sense for you? Do they not? Or do you need to start devising a path forward for it to make sense for you in the future? And as I said, make sure you consult with your CPA or tax professional. The income eligibility requirement is really, really critical. I've seen many folks that have businesses, they're solopreneurs, but they're not declaring any actual compensation or earned income that they're paying Medicare and Social Security tax on, which means they don't even qualify to establish one of these accounts. And you have to be very careful with that, because I've seen individuals where they'll attempt to open a solo 401k and they don't have any earned income. Well, within the IRS guidelines, if you go to the IRS website, irs.gov, it talks about recurring and substantial contributions to an employer plan like a 401k. If you don't have any earned income, you can't make contributions. If you can't make contributions, you likely aren't even eligible to establish the solo 401k. So you have to be very careful with that. Maybe you're better off with just an IRA or other type of account. All right, so that being said, let's now transition to our question of the day. Our question of the day comes from, he doesn't have his actual name, but he says, at Long for Dream. He says, I'm 64 and retired, but I get income from different investment sources. What choices do I have if I don't have W-2 income? So that's a great question. If you don't have any W-2 income, you don't have any earned income, you can't contribute to an IRA. But if you have existing IRAs, 401ks, other retirement plans, you can roll over or transfer those funds into a self-directed IRA. So self-directed meaning you can self-direct into real estate and private equity and various other alternative private market investments. And that's exactly what we do here at Equity Trust. Is as a custodian, we permit investors to invest in those unique private assets away from maybe the traditional stock market. So in conclusion, you can still have a self-directed IRA providing that you have existing retirement monies to move into the account. If you want to make contributions, that's where you're going to have to devise a plan to show W-2 income on an annual basis. You're going to pay your taxes, and then that will afford you the ability to make contributions. Going back to the SEP and the solo 401k, important to understand that those accounts can be self-directed. So here at Equity Trust, if you open up a SEP IRA or a solo 401k, you can make contributions to those accounts if you're eligible. You could potentially roll money tax deferred into those accounts, and then you can self-direct into a wide array of private market investments. That could be real estate, that could be private equity, that could potentially be gold and silver. You will hear occasionally, and one of the pros to a solo 401k is that with a solo 401k, when investing in real estate, specifically when you're involved in a debt leverage real estate acquisition, you could potentially be exempt from a special tax called unrelated business income tax, also referred to as unrelated debt financed income tax, in the instance of the solo 401k taking, or the IRA taking on leverage or taking on debt when acquiring real estate. That could be in a real estate partnership, or the IRA or 401k owning the real estate directly. Now, I did say potentially. There can be circumstances where a solo 401k is involved in a debt leverage real estate acquisition and still incurs UBIT. But in many instances, you'll learn the solo 401k can be exempt from UBIT in a debt leverage real estate transaction. And that's why some real estate investors are very attracted to that solo 401k. But keep in mind, in order to take advantage of that benefit, you have to qualify for the solo 401k. I hope you enjoyed this session on SEP IRA and solo 401ks. You'll also see in the comments box our advanced self-directed IRA course. So if you're interested in diving deeper in these various topics and other subjects, you're welcome to take advantage of that. Keep joining us in our Getting Real videos. We look forward to seeing you on the next program. As always, keep leveraging compounding interest in the absence of taxation.